the yields going up. Just the opposite is happening with the market value of the bonds. So there better not be a bank run, because if there is, that will be revealed. And remember, the FDIC has barely more than 1 penny for the insured deposits, let alone, are they ready to show us that they're ready to bail everybody in? I think so, but it is a vote of no confidence. That's what we're witnessing here, and that's where the danger lies. I'll also point out this headline, which I think is very interesting and something that obviously we've got to pay a lot of attention to. And it basically is saying a reshaped Fed may hold sway for decades. And it won't hold sway for decades because, well, I could be wrong about this, but I don't know that the Federal Reserve is going to be around for decades, or at least as an absolutely independent agency. Bond yields surge as political and fiscal woes start to bite, and gold hits a new high. And of course, we're seeing silver surging, the spot contracts for both gold and silver surging right now. So what's really happening? First of all, we know that the debt markets are the largest market. And since it is those debt markets that creates the new money in the system, we have to pay a lot of attention to it. We've been talking on a global basis how the 30-year bond, the long bond, has really been struggling. And as a little reminder, let me show you how bonds work. These are interest rates. This is when the bond is issued, and this is the length of maturity, right? So when interest rates go up, bonds must always be priced at market. So the market value of the bond goes down.
Bonds are the foundation of the financial system, but they're caught in a dangerous cycle. When interest rates rise, existing bonds lose value. This puts banks, pension funds, and even central banks under pressure, since many hold massive amounts of older, low-yielding debt. If investors demand redemptions or banks are forced to sell, losses become unavoidable. That's why officials fear bank runs. They expose the hidden fragility of the system. The longer the bond maturity, the greater the volatility. And with governments relying on debt to function, the risks embedded in these markets ripple through every corner of the economy.
All those bonds and all that debt, not just bonds, but mortgages, car loans, any of that debt that was issued during that 15-year ZIRP, zero interest rate policy, all of those bonds, whether they're in the banks or they are at the Federal Reserve or any of the central banks on a global basis, they're all deeply underwater. So if there is a run on the banking sector and the banks are forced to sell the bonds into that market, they're in deep, deep doo-doo, because the losses will then be realized. That's why it's so critically important for there not to be bank runs, because then the lie gets revealed. On the flip side of it, okay, when interest rates go down, so the bonds that have been issued in this higher interest rate environment, when the bond interest rates go down, then what do we have? We have the current market value of the bond that goes up. But what I want to bring out is, if this is when the bond is issued, this would be short term, and then as it goes down the line, it's longer term. And you can see whether it's up or down, the longer the maturity, the greater the volatility. So now let's get back to the headline and why this matters. Because governments around the world, and certainly here in the U.S., need to borrow more, but they're borrowing in shorter and shorter term, because globally the viability, to be honest with you, of these governments and their ability to pay with debt already at nosebleed levels is very much in question.
Across the globe, governments are borrowing more than ever, but increasingly at shorter maturities. Investors are hesitant to fund long-term debt, questioning whether nations drowning in obligations can ever repay. This signals a crisis of trust. The U.S. no longer carries a AAA credit rating, meaning it must pay higher yields just to attract buyers. Governments can print money to service debt, but inflation follows, eroding the value of repayment. The so-called safe haven status of sovereign bonds is under threat, forcing a reevaluation of what true security looks like in an age of mounting fiscal vulnerability.
That is a key in this confidence game, because they call them vigilantes, just sort of like they call us a bug and what have you. They want to denigrate what doesn't work in their favor. But to be perfectly honest with you, what that tells me is that people are losing confidence in governments on a longer term basis. So, okay, any government can print the money that they can. If they issue a bond that's in their currency, they can print the money and it costs them virtually nothing to print it and then repay you. That's why we've been led to believe that government bonds are the safe asset and a flight to safety trade. They're not, because they're still debt. And at the end of the day, whether you are a government, a corporation, or an individual, your ability to repay that debt is going to matter. And let us not forget that the U.S. is no longer in any of the agencies AAA rated. And that means we have to pay more. But with the yields on the longer term debt going up, okay?
Financial systems are built on confidence. Once that erodes, stability falters. Rising yields suggest investors no longer believe governments and central banks can maintain long-term credibility. The Federal Reserve faces immense pressure: lower rates to stimulate the economy and risk fueling inflation, or keep rates high and risk a debt crisis. History shows the danger. In the 1970s, political pressure led to loose monetary policy, triggering runaway inflation. Today's parallels are striking. If the Fed bends to political demands again, inflation could accelerate sharply. Each policy misstep widens the gap between official assurances and public trust, pushing gold and silver higher.
The yields going up, just the opposite is happening with the market value of the bonds. So there better not be a bank run, because if there is, that will be revealed. And remember, the FDIC has barely more than 1 penny for the insured deposits, let alone, are they ready to show us that they're ready to bail everybody in? I think so, but it is a vote of no confidence. That's what we're witnessing here, and that's where the danger lies. I'll also point out this headline, which I think is very interesting and something that obviously we've got to pay a lot of attention to. And it basically is saying a reshaped Fed may hold sway for decades. And it won't hold sway for decades because, well, I could be wrong about this, but I don't know that the Federal Reserve is going to be around for decades, or at least as an absolutely independent agency.
Since the 2008 financial crisis, the global system has relied on extraordinary measures: low rates, money printing, and bailouts. Now those same tools are running out of effectiveness. Rising yields and inflation reveal deep cracks that officials can no longer paper over. Digital currencies and new financial rules are quietly being introduced, echoing past systemic shifts like the 1971 end of the gold standard. These transitions happen gradually, then suddenly. The danger isn't just inflation, it's hyperinflation, where confidence collapses and money rapidly loses value. Precious metals' recent surge signals that investors see this risk looming on the horizon.
Everything is changing right now. Everything is changing. The entire global financial system is changing. And what's happening in the bond market is an indication of the erosion of that confidence. And it's that confidence that holds everything together. So what you can easily say is that confidence is eroding. And if any central bank is in any government's pocket, simply doing the will of whoever is in power, well, what do they want? More inflation. They don't want austerity because then people get upset and they're not going to get reelected. Now, is getting absolutely reelected the single most important thing? Not if we're dealing with hyperinflation. So if the Fed, this is so parallel to what happened with Nixon and taking us off the gold standard and handing all the control over to the central banks. This is exactly the same kind of playbook because he had Fed Chair Burns in his pocket. In other words, Nixon was able to inspire Fed Chair Burns to lower interest rate, which inspires more borrowing and spending and generates greater inflation. So everything that Nixon was talking about, how he was fighting inflation and blah, 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 it was a lie, a big fat lie. And the problem that we're in right now is that if indeed the Fed lowers the interest rates, which chances are pretty good, they're going to do it at the next meeting. There's been a lot of pressure to do so. What that means is we're going to experience more rapid inflation. And what that means is that the confidence level will erode even more, and it is dangerously close to going below the lowest level that it's ever been. Technically speaking, that could be the signal to engineer the hyperinflation.
The warning lights are flashing. Gold is breaking records, and silver is climbing toward levels not seen in over a decade. Both remain undervalued relative to the risks ahead. For individuals, this is a call to action. Build resilience beyond just financial assets. Secure food, water, energy, and community support alongside wealth preservation strategies like physical gold and silver. History shows that when trust in money and governments fades, tangible assets and local networks offer true security. The system is changing rapidly, and being unprepared could be devastating. The time to act isn't tomorrow, it's now.
So this is why I wanted to talk about this today, and I'm hoping that you have some questions on that. What was in here? No, it was the one on the Federal Reserve. I mean, honestly, do I think the Federal Reserve is necessary? Not on a gold standard. You don't need a central bank because the money's created from savings. In the debt-based system, in this completely manipulated system, maybe you do need a central bank because their job is to maintain your confidence and regulate the rate and speed of inflation so that you don't lose confidence in the system. But we're at the end. That's what all of this is, and make no mistake about it. I will say this, and I will say this, and I will say this until somebody finally will come to me and go, you know, you talked about that, but the Genius Act changed everything. Whether you realize it or not, whether you notice or not, is not relevant. Just like what happened in 1971 with Nixon, just like what happened in 1933. The system changes, it changes quietly, and then they force adoption. They got enough adoption of the digital currencies and all this kind of stuff to go ahead and force it. System died in 2008, and here we are. If you don't have your sound money strategy in place, and you haven't created that resilience on food, water, energy, security, barterability, wealth preservation, community, or shelter, I cannot encourage you strongly enough to get it done, because that's where we are in this system. At any moment, something could happen that would frankly take the system down and make everything a lot more noticeable. Gold surging to new highs, silver above $41 an ounce, headed to that 50 mark. In both cases, severely undervalued, but that is a warning, and I suggest that you take heed.